Hey everybody, how we doing? A long time no see. Welcome to all of you who are just coming over from live trading with Benzinga. Spencer Israel here, and I am very, very, very excited for the show we've got right now because this is something that we've been doing. If you've been watching the channel, you know that we spend all day talking about stocks and some crypto, but mostly stocks. But you guys know that I'm passionate about other areas of the market. Mainly the umbrella term that is alternative investments, right? There is a whole world, multiple worlds out there outside of the stock market, outside of the bond market, outside of crypto, dare I say it. And so what we've done is gathered a few people for the show, a few guests that are going to talk to us about that world, mainly real estate. Okay, this is a hot market right now. You know this. I know this. There are macro forces at play. The residential market is on fire. The commercial market is on an upswing from COVID. You've got inflation on people's minds. So this is going to be a different kind of show, right? We're not going to be talking about the stock market, but I really do hope that you learn something from this show and maybe take some action in terms of just adding some sort of diversification to your portfolio. Yes, Banzai, whether it's REITs, doesn't really matter, right? I mean, I'm sure each guest is going to want you to invest in their own platform, which is great and all. But the point that I'm trying to bring across here is, think about your portfolio like a pie. You've got slices devoted to stock, slices devoted to crypto, bonds, I'm sure. But consider real estate, consider the whole world of alternatives out there as well. So my first guest here, who I'm going to bring on in a couple of minutes, is Aaron Halfacre from Modiv. And we're going to talk about this. Modiv has had a lot going on. We last spoke with Aaron about a month and a half ago, and a lot has happened in that month and a half. Just in terms of Modiv, but also just in terms of the real estate market, right? There's those of you following know that there's the whole iBuying thing. That's interesting. There's the Evergreen thing in China. That's interesting, right? So there's a lot going on in the space here. And we're going to talk to Aaron about all that here in a second. A few quick housekeeping items I want to start with. First, this is Benzinga All Access. This is one of the ways that Benzinga monetizes our YouTube channel. All of the guests on today's show have paid Benzinga. However, none of them know what I'm going to ask them, or even better, what you're going to ask them. Yes, you. If you have a question, drop it in the chat. I will do my very best to ask your questions. Whatever, there is no question too dumb. Even if your question makes no sense, I don't care. I'll ask it. And then we'll acknowledge that it made no sense later, but I'll still ask it, right? Maybe. So drop your questions in the chat, whatever questions you have about the company or about the asset class as a whole or about real estate. There's no question too dumb or too out there. I shouldn't say that because maybe there are. So all of our guests have paid to be here, but they don't know what I'm going to ask them. They don't know what we're going to talk about. And the conversation will go where it goes. How about that? So that being said, if we could get the show off on the right foot, please hit that like button for me. I'd appreciate that. Benzinga would appreciate that. My next guest would appreciate that, I'm sure. And I think with that being said, guys, let's see if we can bring him on. I think we have him here. Aaron Halfacre, the CEO of Modiv. And there he is. How are we doing, sir?
I'm doing well, Spencer, and yourself?
Doing fantastic. So I just want to start with a recap I'm assuming that not everyone watched the last time you were on our channel. It was a month and a half ago. It was a long time. So let's start with just a recap. What is Modiv? What do you do?
Yeah, so Modiv is a real estate crowdfunding company that has built the single largest equity REIT from crowdfunding. So no brokers, no intermediaries, direct to consumer online. We're about a $450 million net lease REIT. So we buy single tenant, long-term lease real estate. That's what we do.
Very simple explanation. So can you explain a little bit how, I'll bring up I'll bring it up on the screen here. But can you explain a little bit about how Modiv works? It
Sure.
kind of says it right there, but
Yeah, absolutely. So I mean, as a REIT, we choose to be elected as a REIT, which is just a tax election. We're a corporation, right? And so a REIT allows us to avoid corporate taxation and just distribute, as long as we're distributing 90% of the taxable income to investors in the form of dividends, then we get to maintain this REIT status. So what we do is we buy real estate and we own title to it. We're buying sort of Walgreens and Costco's and industrial manufacturing facilities and certain buildings that have single tenants, long-term leases, and they pay monthly rent. A lot of these leases have annual rent bumps in them, so they increase over time to fight off inflation.
mm-hmm.
The rent comes in, and we distribute that as a form of dividend to our investors. Pretty simple, monthly dividends, Modiv.
Oh my gosh. I did not put 2 and 2 together, I don't think. Monthly dividend. That's good.
Yeah. And so, it's really, we have sort of roughly, 45% leverage. So not highly levered. This is very different than when you're buying a house or an apartment complex, which has a different type of lending environment. And we're really focused on the long term, right? So you're not going to see, crazy, sexy, skyrocketing returns, but you're also not going to see typically the volatility of some of the cryptos, things like that. You're going to have steady income coming off of these. It's what real estate does. That's why it's a good alternative.
Can we talk about the selection process? How you said what you would typically invest in, but how do you select that?
Yeah, good question. So we have what is called a pipeline. So I came from the institutional real estate background. So we have a process that we run. We have a team that goes out and looks for deals. And we look at, we probably look at $100 to $200 million of deals every 2 weeks. And we're underwriting them. We're looking at the packages. We're doing the financial modeling. And then if we like them, we'll submit what's called an LOI, or letter of intent. And that says, look, we're willing to pay this on these terms. If we win the process, and it's been very competitive lately, a lot of people bidding on real estate. If you win the process, then you go into what is a PSA, a purchase and sale agreement. And then therefore you start running your third party due diligence, and you're sightseeing the properties. Our chief investment officer is right now in Ohio today, looking at an industrial manufacturing facility that we're going to look to take down. And so and then the process is you fund it and you close the deal. And then you manage that property like you would manage any investment property you would have.
I'm just scrolling through the list of your offering or your investments here, and I'm seeing some Vegas, seeing some Cincinnati. We got Florida. We got office space. We got retail. Yeah. So just there's just a quick tease of their portfolio. As an investor, what are the qualifications that you need to have to invest in Modiv specifically, not real estate probably?
Yeah, so Modiv actually is we recently announced that we're going to be closing our offering. So historically, investors could come in. We're closing our offering because we're going to seek attempt to seek a listing event. And so we've disclosed that. I can't really say anything else beyond what we disclosed in our press release. But an investor typically comes in, they have to have a minimum of $1,000. It can be accredited or non-accredited, it doesn't matter. And as long as they meet the requirements of being an investor, which is, this is $1,000 isn't the only $1,000 they have. And then they can come in. But like I said, we'll be closing our offering later this month. So we're actually not here necessarily today to have people come in and invest. I'd like to talk about real estate. I love real estate. And I think everyone should think about real estate in their portfolios to diversify against stocks and bonds and crypto, even if it's not Modiv.
You just sort of danced. You mentioned it, and then you danced around the golden goose here. What can you say about, as you put it, the listing event? What does that mean, really?
Yeah, so we're already a public company. So we've been filing Qs and Ks with the SEC for over 6 years. So we're fast on how to be a public registered company, but we're not traded, right? So we are a non-traded REIT. But we are also, as I mentioned, a crowdfunded REIT. And we're the first actual crowdfunding REIT to have a publicly traded security. So you can there's already a security out there called MDVA. So Michael Delta Victor Alpha, that's our ticker for our preferred equity. We did that about a month ago, a little bit after we did the first call with Benzinga. So we went out. It's New York Stock Exchange listed. We got an investment grade rating, and so we had great receptivity. Wall Street seemed to like it. It's trading up, I believe, right now. And so the view was, the markets are doing well. We've gotten to that size where it makes sense to be traded on exchange, and so that's what we're going to seek to do. But again, I don't want to talk about that. That's still a little bit down the road. We may not. The markets may change. We may not be able to execute on that. I always want to caution people that there is risk in any of these types of investments.
Fair enough. Fair enough. So okay, then let's talk about real estate, which you said you're passionate about. It's frankly, it's hard not to be interested in real estate right now. I want to get your thoughts, just broadly speaking, just about this macro environment of inflation that we're in right now, that whether it's transitory or not, I guess it depends on the day, it depends on who you ask. But what have you seen in the last 6 months in terms of just demand, supply side demand, investor demand, just on your platform for real estate? Because every day you see headlines that investors are seeking inflation hedges, right? You're right. So I'm just curious what you've seen on your platform in terms of
yeah. So look, I think we're seeing a lot of different phenomena, right? We're seeing really low rate environment, which means that there's an abundance of capital out there. That capital is chasing yield, right? They're trying to find things to put that money to work. Real estate has been a benefactor of that, right? We've seen that in the residential side. We've seen that in the commercial side. Yeah. In commercial side, you see cap rates. Cap rates are, the 1 year yield equivalent on your property. Those have been compressing. They're getting, the tighter the cap rate, the higher the purchase price. We're seeing the markets across all the asset classes, cap rates have been tightening. And that's due to demand, particularly for assets that have a natural hedge against inflation. So do their rents go up, right? I live in Southern California. I'm in Phoenix today, but I live in Southern California. I can see, I live near Newport Beach, and you can look out on the ocean and you can see tanker ships all the way down from Long Beach. And this is a supply demand. This is why we're having inflationary concerns, because we can't get a lot of our goods out on off the shoreline into the stores. And that's creating price inflation and different things. People are clamoring for things that are going to offset that, right? And what do I have that's going to either provide me more real income or an offset to this inflationary concern? And I think that's why, historically at least, real estate has been favored for that.
Can you explain a little bit about that that hedge? I mean, how exactly does real estate work as a hedge against inflation, or maybe the long-term correlations?
Yeah. So the real estate, typically as a real asset, it's an appreciating asset class, right? So it has the ability to appreciate. It's not just a deteriorating asset class. And then if you have lease rental income that is subject to either CPI rebalances or just grows, right? So you have contractual rent bumps, that allows the rents to go and keep pace or exceed inflation. So if you have a flat lease that has no rent bump, that's kind of like holding a bond. That bond will change in value because it can't change its coupon. It's fixed, right? And so the ability for income to be increased from your rental properties is what real estate has. I mean, you think about a hotel is the shortest lease duration, right? It's 1 day. They have 1 day leases effectively, and people come in, and so they can change the price a month from now materially because it's a 1 day lease. If you go to something that has a 30-year ground lease or a 50-year ground lease, they may not have any, and they don't have rent bumps, then they are the other end of the spectrum. So that's what real estate does. It just provides you an offset for inflation. Real estate historically, if you looked at it in the Yale endowment model, things like that, there's a place for real estate in everyone's portfolio because it tends to be countercyclical to your stock market movements or your bond market movements, just because of the nature of the asset class.
And just like on both sides of the market, on the commercial and the residential side, I know you're mostly dealing with commercial, but what do you make of the market right now? Residential, obviously, everyone knows the story there. It's on fuego. But where's commercial at right now as it compares to residential, and what do you make of that?
Yeah, so it is interesting. Going back to that, the low rate environment, tons of capital, tons of institutional capital too. We're seeing it on the residential side, right? I think to your point, it's really on fire. It's probably more on fire in maybe an unhealthy or like speculative way than it is commercial, because we have so many institutional buyers. We talked about the iBuying briefly in your thing. when you open it. It's like, with algo buying of single family homes, which are pushing out the actual new buyers of these homes in a way, and people are chasing the returns in single family homes have been sort of, eye opening. Commercial real estate has been very aggressive. Don't get me wrong; it's still a competitive market there, but there's still fundamentals. You still have good solid credits from the tenants. You have contractual rents that you can see. So it's a little bit of a different beast, but it's certainly gotten pricier there too. I wouldn't feel that commercial real estate's out of hand, but the market overall, real estate overall, is definitely benefited from a lot of cheap capital.
Since you mentioned it, I guess I'll give some background. If you don't know what iBuying is, short for instant buying. It's this business model that platforms like Zillow, Opendoor have adopted, where they're basically, if you want to sell your home at a snap of a finger, you can sell it to them, and their proprietary models and algorithms will be able to buy it from you at one price and sell it for a profit later. Bit of a I'm not quite sure how to. I guess the model hit a bit of a hiccup. Zillow, it was not quite working for them. They lost a lot of money. They've exited the business. Opendoor seems to be working for them. Aaron, do you have thoughts on that model? You mentioned institutional capital. I think iBuying sort of falls into that umbrella where it's like anybody that's not an individual home buyer competing for homes. Do you have thoughts on just what happened there?
Yeah, it's an interesting thing to think about. So you got to go back to the global financial crisis and the debacle of Lehman and Bear Stearns to really see the genesis of this movement, right? Because there was a ton of single family homes in foreclosure, and what happened was, Blackstone was one of the first, which eventually became Invitation Homes. So there's a lot of, American Homes for Rent did this. Sure. A lot of them started buying up tons of portfolios, pennies on the dollar, and the question was, are these an asset class or a trade? Because people thought they'd just recover and sell them. But they didn't. They kept buying. And then that established it as an asset class. More institutional capital came in. And then these platforms, Opendoor, Zillow, anyone who had a natural platform to see firsthand where those properties existed, started attracting hedge fund capital or other types of capital. Said, look, I'll give you money, you buy me assets. And they started buying them. And they've been buying them a lot faster than, John and Jane Doe can do. Right? Because they got to go get a letter of credit from their bank and they got to go tour the properties. These guys are just like, boom, we'll buy it. Boom, we'll buy it. And what happened, if you think about Zillow's model, they were using their algos, which we all see the Z estimate, right? And I've had homes and I'm like, no,
I love this estimate, man.
It looks good some days, but you're like, nah, that's not real. But what happened was it became real, right? Because they started buying properties really quickly. So think about they've just acknowledged that they have to take these large write-downs because they overpaid for these properties. In Phoenix market, in Dallas, Fort Worth, all these markets. So that meant all those times those were home buyers out buying, they were getting outbid, and that was raising the prices. So then the next time someone lists their property, what does a realtor do? They go look at the sales comps, and the sales comps say, well, look, everyone's up 10%. So the buying that is caused, even if it was an inaccurate buying, has led to this bubble of real estate prices in some markets.
Yeah. Okay. You said a lot of things there. Starting with anytime you have to start with, well, let's go back to the financial crisis. It's sort of like, oh, okay. But yeah, I think all that makes sense in terms of the residential side of the market and iBuying. I guess we're going to have to just see how it shakes out, right? Because Zillow said not working, Opendoor says it is working. I have in my notes here a point to ask you about Evergreen. I'm wondering if you have thoughts on that. For those, again, who don't know the story, Evergreen, the largest property developer in China, filed for bankruptcy, defaulted on its debt. I don't know. I'm not smart enough to understand how that could affect us here. Maybe you know the market better than I, so maybe you can explain, in theory at least, how could a default from a property developer in China affect our real estate market here in the U.S.?
Yeah, so really, it goes to. I don't want to do this again, but I'm going to do it again because the global financial crisis had another example. What did we have there? We had lots of debt go in default, and it causes a spiral. What you do is you lose confidence. So Evergreen has over $300 billion of debt. 19 billion of it is only sort of foreign investors. There's now a host of other Chinese property developers, those smaller but equally at risk of defaulting, if not some of them are already delayed on coupons. There's a bunch of US or non-Chinese dollars in those bonds. And if they default, then there's a loss, but then that also causes a fear to set in. And contagion is not a good thing if it's fear. It's great if it's appreciation, but it's not great when it's fear. So there's a real risk that destabilizes the bond market if they don't address it. Now, they've been really quiet. You don't see much in the news because China, what is China going to do? Is China going to step in and make them whole, right? Or are they going to let them fail? That's the question. We don't have that answer yet, but it'll lose a confidence. That'll impact the trade relations on the margin too, because you need credit to build businesses, right? If you can't get credit, you can't grow. So that's the danger there.
You just said the C word, contagion, which is a super bad word, but you said it. So okay, the takeaway there, I guess, is again kind of wait and see. I did just think of a follow up though for the iBuying point. If we can go back to that for a second, there was a narrative, Aaron, going around on the internet that Zillow and these iBuyers, they're just jacking up. They're the reason why homes are so expensive now, because they're cornering the market and they're bidding up these homes, and it's Zillow's fault. It's Opendoor's fault. It's these iBuyers. They are why we meaning home buyers are priced out of our homes right now. What is your reaction? I think I know what you're going to say, but what is your reaction to that narrative?
Look, I think they're an influence to it, right? So certainly when you have billions of dollars available to buy properties and you can buy them faster, that's going to affect that. But I also really think it's human nature, right? We came out of COVID, people decided, I'm going to leave the big cities, I'm going to go move somewhere else where I've always want to live because I'm working remotely. And so they flooded the national markets, Boulder, Austin, all these markets. They started, I'm going to buy. Rates are super cheap. People think, no problem, I'll put 5-10% down, I'll just go and do this. I think home buyers and people's pent-up energy from being trapped in during COVID are just as culpable as the institutional buyers. Bubbles are not formed by any single entity. And I'm not saying there's a bubble, by the way, don't get me wrong, I don't think there's a bubble, but it feels really frothy right now. And it feels hard for someone who's just starting out. How do they buy a house? It looks really difficult. And I think that's because there's so much capital chasing so few assets. So it's both parties.
Yeah. I would personally agree with you, right? It's a complicated. It's never quite that simple, right? It's never that simple as, oh yes, it's those guys' fault, right? There's always more than one factor at play.
Right.
I want to say, so I always save some time for questions from the chat. We have a couple here for you. One of them is from, let me find who asked it. Jim Cruz asked, just regards to Modiv, how does Modiv differ from Fundrise?
Yeah, great question. We recently did a crowdfunding ebook out there. You can see it on our site, I believe. But we talk about crowdfunding. It's a pretty diverse spectrum. Fundrise and Modiv are similar in the sense that we're both asset aggregators. We are owning title to assets, where some crowdfunding companies are just syndicators. They're matching a buyer with a sponsor of a property. So we are the sponsor. We own the properties just like Fundrise does. The difference with Modiv is we're fully internalized. So I'm an employee of Modiv. You pay Modiv no fees, you own Modiv, right? So the crowdfunding platform, there are no fees charged. And so we're not an external manager. So in Fundrise's concept, it's more like a mutual fund company. They are a manager of a lot of different REITs, and those REITs don't have employees, and they pay a fee to Fundrise to manage them. And so that's the difference.
Got it. Yeah. Here's a good one from Andrew. He's asked about investing in Modiv versus whatever returns he could theoretically get on his own from his own property.
Yeah, look, I think you're right. People should look at the risk return and the opportunity cost of every decision. So there are people who are on bigger pockets and they say, look, I can go own a duplex and I can do better than I can in REIT. But yes, you can. But you also take on usually personal liability of the mortgage. You have to fix the tenant, the toilets, and take out the trash if the tenant doesn't. You have to deal with all those things. If you don't have that capacity or desire, then in a passive investment in a REIT where there's professional management, and I've been doing this for 25 years, is the way to go. But there's a trade-off, right? There are obviously trade-offs. And so I encourage people to own real estate in all forms, not just one form.
That's a lot of real estate.
You don't have to own, you can $1,000 in Modiv, and you can also own your apartment. I mean, and you can own some other, there's some publicly traded REIT stocks. There's other ways. So you can have a portfolio that produces income that doesn't require millions and millions of dollars.
And then Born to Be Free is asking, does Modiv itself, or maybe he's asking for you, does Modiv itself have any overseas exposure? Just going back to the Evergreen thing.
No, so we only own properties in the United States.
Okay, that's a good answer. Good question and a relevant question and a good answer. Aaron Halfacre is the CEO of Modiv. I guess the last thing I'll leave us, I'll have you leave us with, Aaron, is what is a typical allocation? You just said everyone should have all the real estate, right? But what is like a typical allocation that you see from your client investors on your platform, or maybe you yourself are not a good example because you're in the business, but a normal investor, right? Like, what is a typical allocation that you see to real estate or to Modiv specifically?
Yeah, so what we see is typically sort of 5 to 10%.
Okay.
And that also seems to match what sort of the Yale endowment model is. That, in terms of sometimes the institutions will have more, but typically that's about what it is. So it's not meant to be, and that can be sliced up into multiple things. It doesn't have to be one investment, right? That 5 to 10%.
5 to 10%. Okay, and I think that's like you said, that's like conventional wisdom, and you probably you won't go wrong with that. But those of you out there with 0%, take notice, please, because your real estate, I mean, it's what we just talked about, right? It's at once an inflation hedge. It's a diversifier. It does so many things for your portfolio. People like Aaron have like made it their mission, right, in life to like bring real estate investments to the masses. And so I appreciate that. I guess before last one, Brian Blockchain asked if you have any dividends on Modiv. Yes, Brian is the answer to that question. As I just learned shamelessly, Modiv stands for monthly dividend, which I didn't put two and two together until 20 minutes ago. So you get the dividends, you get the diversification, you get the diversification, you get the inflation hedging. So real estate, I love it. Aaron, you love it. And thank you so much for joining us today. Modiv.com, the URL, guys, is on the screen. If you haven't already, check it out. I do recommend, at the very least, learning more about the asset class, because it is probably one of the most common ways that real investors diversify themselves. And so, Aaron, thank you so much for coming on today, and have a good one.
Thanks, Spencer. Thanks so much. Appreciate it.
All right. Hey, let's pivot here for a second. We will come back to real estate in just 1 second. Maybe not 1 second, maybe a few seconds. But I want to bring on our next guest here today. Someone who was a finalist at the Benzinga FinTech Awards just last week, Stephen Mathai-Davis. He's a CEO of Q.ai. I am super into this platform. It's basically an all-in-one investment platform for what? For ETFs. You guys know that's my favorite thing in the whole wide world, right? I love me some ETFs. So let's bring Stephen on the show here. Stephen, how are we doing today?
Pretty good, buddy. How are you?
Doing fantastic. How's your day going?
Going pretty good. We're launching some new investment kits on the platform, so pretty excited about that.
I cannot wait to hear about this platform. I sort of teed it up for you. So tell us about Q.ai and what it does.
Yeah, just high level. We're trying to democratize the hedge fund. We're bringing institutional grade investing to the individual investor. We're going to let folks invest the way high net worth individuals invest, the way other hedge fund managers invest, with a click of a finger. We call it a one-click investing experience, but realistically, Spencer, if you take a step back, the way investing is really done is nobody thinks about stocks or ETFs. First, you think about an idea. Imagine you could just click into an idea and have AI do the rest for you. That's what we've built, and that's what we call our investment kits. And
so,
go ahead.
Yeah. So how does it actually work? Like as a user?
As a user, you come onto the platform, you sign up. We're partnered with Apex Clearing, so it's a legit broker dealer, FDIC and SIPC insured. Open up an account with Q.ai, and you can say, "Hey, I want to invest in a strategy or a kit that's going to play inflation." Because I'm in the mood to play inflation. I click the inflation kit, boom, put in allocate whatever money I want in there, and then AI does the rest for you.
So there's a few different platforms out there that also their tagline is bringing the hedge fund strategies to the masses, right? So explain exactly how your platform is different from the ones that are already out there.
Yeah, well, we're a little bit different, right? So we're a full-blown IRA.
Okay.
So we're actually managing the monies. Two, I think one of the more descriptive, I would say descriptive differences is that we're completely AI powered and quantitative. There's no human intervention. The only human intervention is coming up with the idea. And then finally, what we're doing on our platform versus others is that we're not funneling you into strategies. Take a step back. Like, that's not what we're doing. What we're doing is trying to help you build, the best portfolio you want around themes and ideas. And the themes and ideas are all managed through AI, through our different algorithms.
So explain that a little bit more, though. What exactly does that mean? Like, I have an idea. Should I just hope that my idea is on the platform? I mean,
no, you come on the platform and say, oh, wow, I can play a precious metals trade. I can play an inflation trade, infrastructure spending, holiday shopping season. I like these ideas that you guys are talking about.
Yeah.
Click, click, click. And you just manage the rest for me, including rebalancing between the kids.
So I guess that sort of gets to my question. So I could just pick as many of your, as you put them, kits as I want on the platform.
As many kits. Think of the kits as content, right? Or something you're buying, an idea.
Could I get on your platform and say, I don't really know, but I know my risk tolerance is A, and I'm 25 years old. I'm super, super high risk, right? And then you would just say, okay, based on that, we think you should invest in growth tech and blockchain.
Yeah, for you, if you said you go through it, we actually tell you what we think you are.
Okay, that's
so cool. We say, all right, so then Spencer goes through and said, Spencer, you're aggressive. You're super high risk aggressive. Yep. You should be investing in emerging tech, the crypto kit, a guilty pleasures kit we have, which is investing in sex, booze, and drugs, or cannabis specifically. And suddenly, you can choose if you want to do it, or you can choose to ignore it and play around with whatever other kits you want.
So what are these kits made of? I mean, they're ETFs, yes?
ETFs and stocks, depending.
Okay. So
and crypto, depending on which angle you're taking.
And you made your own portfolios.
Yeah. So you take a step back. Like, if you think about portfolio composition, the way it's done on the institutional side, it's not built around just individual stocks or ETFs or options trades. It's around themes and ideas. So we took that process and we broke it down and said, okay, right now, the way fintech is done and the way it's delivered to people is just a finished portfolio. But who we're targeting, which tend to be more mass affluent millennial and Gen Z investors, they want to have more of a say in how the portfolio is constructed. So what we're permitting people to do is construct whatever portfolio they want around these themes or these kits that we're managing ourselves. So the themes and kits, the kits themselves are stacked with stocks, ETFs, crypto, depending on what we're talking about. And then you build your portfolio of kits. Or you can just choose one individual kit. But most folks are on the platform right now are playing around with multiple kits at one time.
How exactly does it, what does the AI do exactly?
Yeah, so it's multi-layered, right? So at an individual kit level, the AI, depending on which kit we're talking about or theme, is not only choosing the securities going into the theme, it's also choosing the weights of it and how it's being balanced between different sub-industries within the kit. And then there's a layer on top of that where if you want to have the AI asset allocate for you dynamically between different themes, we do that as well. So it's a tri-layer.
Okay. But if I wanted to be super active, if I wanted to manually or actively rebalance myself, could I do that? Or
yes, you can.
I can.
We're rolling that out. We call it the do-it-yourself portfolio or the Robinhood experience, which is just stay out of it. I want to choose whatever kits, and you guys do the rest for us.
Yeah. just to be clear, this is right now it's just a mobile app, right?
This is just mobile.
Just mobile, right? And is a web platform in the works down the road, you think? Or
We're going to be launching a web platform in 1Q.
okay.
The reason we did mobile was, given who we're marketing towards, we did a lot of market research which suggested people really wanted it first on a mobile app.
So I'm trying to think, like, what is the idea here? A Robinhood or a Webull type of app, but just toned down in terms of crazy, like, for lack of a better term, like YOLO-ness, right? Is like, this is not for like you to buy weekly out of the money options, right?
Yeah, it's good. That's a great question. The way I think about it is it's kind of the next gen in the investing apps, which is a hybrid of the Robinhood experience on one side.
Yeah.
You do it yourself, and then the robo-advisor, like the Wealthfront experience.
That's
Look, if you look at younger folks, we all want to have more of a say. If you go into the robos today, and this has been a criticism I've had of them for a while, it's yesterday's like wealth management model. All right, you're going into 60-40, you don't really have much of a say, and we do everything. Well, okay, that's great for Gen X and baby boomers. That's not what younger millennials and Gen Z are looking for. They're looking to have more of a say in the asset allocation. On the other hand, you really don't want to be introducing stock-specific risks all the time and figuring out, am I going to buy which EV car am I going to buy? How about you just play a theme that's dynamically trading it, right? And that's kind of where it's kind of guardrails, if you think about it a little bit. Like, I want to play the theme, this idea. You do all the rest for me. And unlike the robo, I'm going to build a portfolio that I really want that's going to be addressing the goals and the values that I want to express.
What are the sort of specifications here in terms of account minimum or what you need to have to open an account on Q.ai?
It's $100 minimum.
Okay.
And that's it.
That's the only anything?
That's the only anything.
That's the only anything. Okay.
Yeah.
I did not. Okay. I thought for sure there'd be more, but that is the only one. Couple questions from our chat here. I guess this one is regarding transferring to or from an IRA, I think. That's what he's asking?
Yeah. So they're probably talking about ACATs also from brokerage accounts. Right now, we're not doing that.
Okay.
We plan to roll that out.
Okay. Something I'm thinking about, as I talk to you, Steven, is like, this is like so admirable, but it's like hard. Like, and I see it every day. It's hard. Like, gambling is fun, and it's irresponsible, and I hate it, but it is fun, and it gets people going on social media and Discord and Twitter and Reddit, all these places. And like, how do you sell them on not doing that as much? It's a very hard thing. I try every day.
Well, we've got this whole push on the other side, which is on our content side. We call it snackable investing content, where we're pushing education, short form education, to talk about why you really shouldn't be doing the YOLO single day trades in and out of things on a daily basis. Should look at things over a shorter medium term. I'm not really sure buy and hold really works. I think that's a different academic debate.
Right.
But we actually rebalance weekly, by the way.
Okay. So that gets
we're trading for you guys weekly.
That gets to my question. If it's not buy and hold, what is it? So you're rebalancing weekly.
Yeah, and that's like you do the real fun, which is what really happens.
And that's based on your algos.
That's based on our AI powered algos.
Yeah. Right. Okay, that's interesting. Super active,
which have been optimized. So it's a hands-free active experience.
As far as that AI, I mean, I assume it's been back tested, right? What, like, can you explain how it might work in different environments? Like, take for example last March, right? March of 2020. Like, what would have happened then?
Well, I want to be careful because I don't want to advertise the performance there. It would have done very, very well. How about I answer in a different way? We've actually optimized the algorithms and the performance of it to do better in volatile markets. Because the real art form in trying to making money investing, it's not about capturing every high day. It's about avoiding the low days, because that's the beauty of compounded interest.
Sure.
And our algorithms are set to optimize to miss all the low days or perform well on low days while grinding higher with the market when the market rallies. The one of the unique things we've done is that we are using play on the wisdom of crowds. We call it the wisdom of algorithms or the wisdom of the neural nets. We have multiple algorithms voting at the same time about the best stocks to own at any given point. And we go with the majority. So different types of algorithms are competing with each other to figure out what's the best security to own, depending on the kit we're talking about.
You have a background in data science and AI, don't you?
Yeah, I do. And trading and portfolio management.
Yeah, and trading. So has a lot of this just come from your own experience?
A lot of it's come from my own experience and frankly, probably the evolution that I was seeing on the buy side.
Explain more.
Meaning that the buy side was going from real traditional storytelling stock picking to in terms of portfolio construction to a real systematic quantitative approach. And what I observed was the transformation occurring in institutional investment management, that none of this was trickling down to the retail market. Individual investor markets got access to technologies and techniques that frankly are kind of ancient if you compare it to what's going on at the hedge funds and some of the elite funds. And that's where our ethos is about tearing down those walls and bringing those types of strategies to the average person.
But do you think like the average retail investor is ready for that? Because in some respects, you talked about how the hedge funds in their heyday, it was all telling a story, right? Well, that's what it is right now on social media. It's telling you a story about the stock, right? Do you think like the retail? I mean, I'm ready for it, but do you think like I don't think I represent the average retail investor because I have a pretty low risk tolerance. But do you think like the average retail investor is ready for this type of systematic approach to investing?
I think it's the same way it's been productized for high net worth individuals. There's no real difference. Okay. It's just the way it's been productized for high net worth individuals has really been developed and explored. The productization of financial products for the average person, it's just been a throwaway. No one's really invested a lot of time. We spent about 2 years. Spencer, you and I have known each other for a little bit, going back to my last startup
at Qualifications.
We spent a lot of time exploring different ways to productize this that would really resonate with younger investors, younger individual investors. So the short answer is absolutely. The longer answer is how do you package it? And by the way, that's the same debate that happens when institutional investment managers are packaging financial products for high net worth individuals and pension funds.
Fair enough. Question from a couple ones from the chat here. One of them from NCal. What is different about your service compared to competitors? I'm going to just assume firms like Titan, for example. There are others out there, but I guess like what is your biggest key differentiator?
Yeah, there are two, and I don't want to throw shade at competitors. I think they're all doing really cool stuff. What we've done is two things. One, the key differentiator for us is that we're AI powered totally, right? So there's no human intervention.
Right.
We're not talking about looking at stocks from a traditional fundamental standpoint and doing storytelling and saying, we like Tesla because of this. We're actually looking at data and letting the data tell us what are the stocks or ETFs to own. Secondly, the bigger differentiator is the concept of the investment kit. The other platforms are actually creating portfolio strategies, and they're selling you a portfolio strategy. We're selling you investment kits or different experiences that you can build a portfolio around. Now, our signature kits typically would resemble what you'd see more as traditional strategies, whether it be investing in global trends, our value vault, our emerging tech, our power factor. But we've introduced other things like limited edition kits, which are short-term trades. So we're releasing holiday spending and infrastructure spending tomorrow. These are two kits that are coming out with the duration of 4 months.
Yep.
You can't get that on the other platforms because that's not what they do. Then we have what we call our select kits, which are really micro themes. Guilty pleasures, that's the sex, booze, and cannabis kit. Another one is precious metals. It's going to be an inflation kit, things like that. And then we're going to have our community kits, which are investing in the top stocks on Wall Street Bets, the top stocks that are talked about on YouTube. So more or less what you can do is take these different types of kits, which themselves are themes. You can think about them as trades, and you build your own portfolio if you want, or you just pick one or two that you like and you write them out. So again, we're a little bit different there because we're kind of creating a more active, hands-on experience for the user, where he or she can build their own experience.
Chazzy is asking, I like where Chazzy's head is at. They're asking about what the fees are and the expenses on the platform.
Right now, no fees, zero. We are probably going to be introducing a subscription model down the road, but it's not in the near future. The app right now is free to use.
What would that, just a monthly, what would that look like? Just like a monthly subscription?
It's a monthly subscription membership. We're going to be using a freemium model, so our signature kits will be free, whereas the ability to go into our select kits, our limited edition kits, our community kits, and our YOLO kits, which will come out down the road, and there's going to be a fee for that. But right now, all the kits are available for free.
Can you share what your AUM is at the moment?
No, we can't talk about that.
Figured I would ask.
That doesn't matter. Anyway.
Couldn't hurt, right?
I would say that the growth has been pretty great. I guess I should give a shout out to everyone in our Discord chat who's been engaging with us and smashing me left and right about new features they'd like to see. But
what is the most requested new feature, out of curiosity?
The requested, ironically, the biggest requested feature has been just an index kit.
What?
Yeah, investing in indices, just so I can trade in and out of our other more active kits. And then secondly, it's been crypto, digital assets.
That makes sense. Yeah, I could definitely see that. So
a small crowd clamoring for options, but we're just trying to get that through the regulation compliance stuff.
That seems counterintuitive to the rest of the. I guess no, because I guess the point here is self-customization, self-directed, algo-driven trading. And I guess who am I to write off options, right?
Come on, if you remember Quantumize, we had all those killer option trades.
It's that's true.
Automating the experience.
That's true. Stephen Mathai-Davis is the CEO of Q.ai. The URL is at the bottom of the screen there. It's tryq.ai. And let me just check real fast. Okay, one more question from the chat. Do the kits include stocks from other countries? I guess what is the universe you're working off of?
Yeah, so I'm going to answer that indirectly. So it's not securities listed in other countries. We do have ADRs.
Okay.
So it is international and kind of mixing up like emerging.
So any U.S. listed security.
Any U.S. listed security.
Got it.
And some kits include both stocks, ETFs, and crypto mixed together.
Got it. All right, Stephen Mathai-Davis, Q.ai. Stephen, a pleasure to chat with you today, and very interested in this platform, and looking forward to trying it out myself, because it seems like it's a nice happy marriage between super crazy off the wall and super boring, right? It's right in the middle.
We're shooting right down the fairway there.
Wait, before I let you go, will the app be available in the Android store?
It will be soon.
It will be. Samuel, it will be soon, Samuel.
That's the most requested ask we've had, but that's coming out in 1Q.
All right, Q1, Samuel. Thanks a lot, Stephen.
Cool. Thank you.
All right. Okay, we're going to go now back to real estate. We were there with Modiv earlier. We're going to come back to real estate with CrowdStreet. I'm going to bring on Brent, Hieggelke, and Chris Pachinger. I'm going to bring them on. Guys, I'm 99% sure I got your names right this time. Let's bring them both on. How did I do?
You're close. We're so close.
Pretty good. You got mine right. I think you gave me a new way to make fun of Chris. So thank you for that.
I'm sorry, Chris. I'm sorry. I spell it out phonetically, and then I butcher my own phonetic spelling.
We'll get it right next time.
All right.
Round 3.
Guys, how are we doing today? How's it going?
Awesome.
Awesome. So let's bring it back to the real estate. We talked a little bit about that earlier, but frankly, the conversation around real estate can be endless. So I want to start off with this question. Assuming not everyone watching now watched our last show like 6-7 weeks ago, tell us about CrowdStreet. Tell us about the platform, what it does, how to get on it, what you need, etc.
Sure. Yeah, I'll kick it off. So we're the top platform for investing in private equity real estate online. And what I mean by private equity are projects that are, large capitalization projects. This is passive investing. And you're investing alongside some of the best real estate developers and sponsors in the country. So these are folks, CrowdStreet basically partners with the best developers that we can source that have projects ranging from multifamily to industrial to warehousing, e-commerce distribution, senior living, student housing, self-storage. So, things that are in the commercial real estate vein. And we bring those opportunities to accredited investors. So, they are generally in the $25,000 range of investments. But we have people building portfolios on our platform for this asset class that for decades has been off limits to most investors. And so this is a great, great way to diversify your portfolio with, things that the hedge funds and the large endowments and billionaires have known forever, which is you want to have, literally brick and mortar investments as a smart hedge to, everything else you're doing out there that might be more speculative. So that's kind of an overall summary.
Can you speak a little bit about what you've seen in the last year or so, just in terms of, I'm not really sure if you can speak to specific returns, but just in terms of activity on the platform and interest from investors, because as we were talking and as we'll talk about in a little bit here, inflation is top of everyone's mind right now, and they were looking for ways to combat that in their portfolios. This is one of them. So I'm just curious what you've seen just in terms of activity on the platform.
Yeah, let me take the beginning of that, and Chris, you can talk to the second half. So, like all things digital, we've seen a massive increase in investors in their interest in their investment activity on the CrowdStreet platform. Because we're a marketplace, when the pandemic hit and things like office and retail became a little, question marks about, are people going to go back to offices? Is retail going to be owned 100% by Amazon, right? Those questions were out there. We saw, because we're a marketplace, we pivoted to the assets that people wanted to invest in. So multifamily, obviously all things housing related, off the charts of interest. Things like e-commerce, warehouse, and logistics, you couldn't find deals to satisfy investors. Warehousing, distribution, logistics, the same kind of thing. So, we've seen investor activity actually, increase dramatically over the last 12 to 18 months, like most digital platforms have as well. Chris, you want to pick it up and talk about, kind of how things look with inflation?
Yeah, and Spencer, you hit it on the head. We're hearing this more and more all the time, but we saw some scary numbers last week, but I think everyone that's been paying attention to money supply and other factors over the past 18 months, inflation's been lurking, and we've seen literally thousands of investors join that they're at least in part they're coming because they understand that not only real estate but commercial real estate's a natural hedge against inflation. So people that are looking for not only that hedge, but something that's actually going to be responsive to whatever inflation does. That's a big part of the story. And that spans across, effectively all parts of real estate because of that dynamic where, rents can raise typically annually. So it's something that we're seeing quite a bit of, and it's definitely been a big part of the story over the last year and a half.
I love the way, like, on your site, I'll show it here. You guys break down just the diversification. Brent, you just sort of mentioned it, but like all the different areas of real estate, right? You got retail, hospitality, senior living is a big one. That's an easy story to sell, right? It's a demographic story. Industrial space, office space, multifamilies. And so I love the diversification. What do I need to know as like an investor? Like, what should I know going in if I were to look into your platform and okay, yes, I definitely want to invest in real estate. Yes, I want to do it through CrowdStreet. What kinds of things do I need to know? What sort of things do I need to look out for?
Well, I think so. Assuming this is new to you, first of all, there's a whole litany of resources available on our site for getting up to speed on how should you think about diversifying through commercial real estate? What should you look for? I think, we have new deals launching every week. I mean, we had a week 2 weeks ago. We launched 6 deals in 1 week. So, create a free account on the platform. You're going to start getting emails announcing every single new deal. You can start listening to the webinars on those deals. You can start hearing the questions that other investors, the smart crowd, that are asking, and you can really take a look, a listen and learn approach, and take as long as you need to get comfortable. But then at some point, you're going to find a deal that sounds interesting, right? It might be close to home, might be a geography that it might be an asset class that you feel is strong, right? Like you mentioned, senior living. You might think that, hey, senior living makes a ton of sense because of the aging baby boomer population, and so it could be a combination of those two things, right? Senior living in an area you like, and you're going to get interested. So you can then, really dig into the deal. We have all of the details of these offerings. I mean, you can spend hours literally digging in to all of the resources we put on the site, and you're going to put in an offer, and then that offer will be accepted. Hopefully, I mean, we do have some deals that have way more interest than we have supply, so there's a few scenarios there where you might have to enter a lottery to get in, but basically you're going to get into a deal, and then from there you're going to start learning. You're going to start getting quarterly updates from the sponsor, and most of our investors, over the course of a year, will look at building a portfolio at whatever value. You might have $200,000 to put into a portfolio. We have a lot of investors that are building $1 million portfolios on our platforms. So there's really a wide range, but think about these as, these are 3 to 5 year holds on average in most cases. So to Chris's point, they're a great hedge against inflation. They're a great hedge against the stock market ups and downs. They're a great hedge against what you might be doing in crypto, which goes up and down, literally month by month in some cases.
Day by day.
Yeah, day by day. So think about this as, okay, I feel good that I am invested in these large capitalization projects that aren't correlated with the ups and downs of the market or the crypto market. And so, think about it from the standpoint of diversification. One of the things that's so interesting about being able to do this on platforms like ours is if you invested in commercial real estate, let's say a decade ago, you probably did so because you were lucky enough to go golfing or hang out at the country club with somebody in your local market that knew how to build multifamily or student housing. And so if you were lucky enough to get invited to invest, you were really invested in one developer, in one asset class, in one market in most cases. Now with something like CrowdStreet, you can invest across the country, across asset types, with a whole bunch of different real estate sponsors. So now your diversification options just went exponential. And that's really the new kind of exciting opportunity here.
Is it all self-directed, or is there guidance that you can provide me as far as like, hey, well, you're pretty overweight the Southeast,
Yeah, Chris, you want to talk about the different options we have?
Yeah, so there are a couple of ways that you can get help. So under the CrowdStreet umbrella, we actually do have an advisory service. Okay. So we have managed accounts, and there's a lot of customers have come to us and said, all right, I know I want this, I want to be a part of it, but to your point, Spencer, maybe I don't want to be the person to make all the calls. Yeah. So maybe I want more of a mutual fund kind of experience versus a stock picking experience. And in that case, we have funds that are, typically there's one every 4 or 6 weeks that's coming out, and they're thematic. But for folks that want something even a little bit more robust, we actually have a custom managed account service. So people will come to us and say, all right, well, most institutions they're going to have somewhere between 5 and 20% of their assets in commercial real estate. I want the same thing. So here's $500,000. What do I do? And we can actually build a portfolio for those folks. So we have a few different ways that we can do it. And that all sits on top of that self-directed marketplace, right? So they're getting access to those opportunities, but they really have kind of a white glove custom-made treatment for it.
Got it. For the self-directed do-it-yourselfers among us, obviously they start with one, but what do you typically see in terms of the number of offers or deals that they would end up investing in by the end of the day or end of the week or whatever?
So most people on average, once they've made one investment, they tend to make 4 or 5 at least.
Oh, wow.
We have many people that end up doing dozens, and it's because of that dynamic that Brent mentioned, which is a lot of these people, they're in commercial real estate, but they recognize the value of, hey, I'm in commercial real estate, but I'm in New York. I don't have a network in Seattle and LA and Dallas, so they can diversify across the country, kind of like the graphic you showed, but also they can hit multifamily, they can hit data centers, they can hit cold storage, all these different little pockets. So you see people that do, in some cases, many dozens, but the average tends to be 4 or 5 once they've taken the plunge on the first one.
Yeah. There are a couple of questions from the chat. I'm not ignoring you, chat. I'll get to your questions in a second. I just have a couple more on my end. The big thing that I always think about with regards to any platform, whether it's yours or any investing platform, is trust, right? Is you have to build trust with the consumer, with the end investor, that the platform functions in your place, that also the marketplace functions. How do you build that trust? I'm just curious.
Yeah. So, when we started the company, we realized that was going to be a core issue, right? Is how to, because we're taking something that's been a very offline experience, a relatively, high price point, right? And bringing it online, the number one thing people are going to need to know is, how do I trust this service? So we publish a ton of marketplace performance information. There's actually multiple places on the site you're going to see it. We go into lots of detail on 2 things. One, how we find the deals that we put on the marketplace, how we source them, what the process is, and then secondly, what's happened so far. So we publish the fact that we've done over 500 deals. We publish, we've already had well over 200. We've had $275 million returned back to investors. So we publish a case study on all of the deals that have gone round trip, right? All the deals that have already sold, and we publish the good, the bad, and the ugly. So good news is, across all of the deals right now, we're sitting at over an 18% IRR. So in aggregate, the deals have gone well, but there have been some deals that haven't gone well, and we'll talk about those. We'll talk about what went wrong. We'll talk about what happened, what we tried to do, what the sponsor tried to do to get it back on track. So we believe in transparency across as much as we can possibly publish on the site. So you're going to see that out on there. So like I said, if you want to dig in, and you can spend a lot of time on the site, both learning and also seeing kind of what has happened to date with over 500 deals that have been on the platform.
So something else I love, and this is something that's on the CrowdStreet platform, but they have resources like how to just get started, right? Not just with CrowdStreet, but just in general, how to think about real estate as a part of your portfolio, which is the thing I'm trying to hammer home here with these shows, is like how to think about a particular asset in the larger picture of your portfolio. Like if you don't know like how much of your total investable assets or how much of your net worth is in stocks versus crypto versus whatever, real estate, maybe like take some time and think about that, right? I'm curious what you guys see, Chris and Brent, as far as like you're working with accredited investors, so maybe like a little bit higher net worth, but like what do you observe? Or I'm sure you do surveys. What do you observe as far as like their allocation to real estate or to CrowdStreet or to any one given deal?
I think yeah, you go ahead, Chris. You go ahead first.
Yeah, so one of the things that I see and hear a lot is just this idea that the 70-30 model is dead, right? So 20 years ago,
is it now? Is it 60-40? Are we going the other way?
So it's something different than that, right? So a lot of the investors that are participating in CrowdStreet, they're thinking about something that's more like a 50-30-20, right? Where that 20 is in just a broad bucket of alts, whether you're talking crypto, whether you're talking commercial real estate, any of the other number of alts that are out there. There's really a revolution with alternatives, especially on the self-directed front. So I heard you a little bit with the last guest, and he mentioned, that all of the new generation of investors, they really want control. And a big part of that story is the alternatives. So most of the investors we're working with, they're going to have 10 to 20% of their, investable assets in things that don't look like, the stocks and bonds you can buy with your brokerage account. And that's pretty much the norm. And commercial real estate, that's usually a big chunk of it, but there's a few different parts of that story that are really still unfolding. But that's really the story, is that 70-30 is dead.
Yeah, and I think just to put a finer point on that, if you go back and read what a lot of the folks that are managing billions of dollars do, right? What can you take away from those folks? You're going to see 20 to 30% of their allocation traditionally goes into things like commercial real estate portfolios. So, that might be a little overweight for folks that are, if you're zero now, thinking about getting to 30% might feel like a stretch. But, to Chris's point, there is a massive increase in the interest in alts. Real estate is the largest part of the alts. So if you're not taking and thinking about 5 to 10% to get started, then you might want to really start analyzing, your overall strategy.
I want to get to the chat here. NCal is asking if either you can comment on foreclosures and the trend there, whether they're going up or down or whatever you're seeing.
Yeah, I would say, we're highly selective in terms of what goes on our marketplace. We're working, like I said, with the best real estate sponsors, some of the best and most experienced in the country that are doing, large scale developments. So they're not really, working in, there are definitely some projects where they can pick up, development project that, they can pick it up for a great price point, and then they can throw in, renovation dollars and then bring it back out to market. But they're not working in that sort of foreclosure market, that you might be thinking about in the residential space.
And Shazzy, I'm dropping a link in the chat to answer your question, but we discussed it earlier. In order to invest in CrowdStreet, you have to be an accredited investor, which the bar to that was lowered last year, but the SEC has terms, qualifications that you have to pass to be considered an accredited investor. And then once you are, there's a whole other world that's open to you, a world like CrowdStreet. And I think the point here is and Brent said this off the top, I believe, but historically, this was a market that was available to hedge funds, right? Pension funds, not like any old accredited investor out there. But that's changing now. That probably, for the best. So I guess as we wrap it up here, guys, how I'm just consulting my notes here, but how do you think about CrowdStreet in relation to other, or maybe real estate at large, in relation to other asset classes, right? Be it crypto or stocks. Like you said, some of these we're talking 3 year holding periods, right? It's not, it's not high flying crypto. I guess how do you sell that to people?
Well, I think I look at it, and Chris, you can take it from after I go. I would look at it again, you got to have something that's a hedge against what you might be doing in crypto. I think it's really important to think about, having that balance and diversification. How do you think about it in the context of real estate? This is passive investment, right? So you're not going to be, unclogging a toilet at 3 a.m. because you got a rental property, you got to do it. This is putting your dollars in and then waiting for those projects to exit, and you're partnering with the most experienced, savvy real estate developers and sponsors in the country. So that's kind of how I think about it. Is what's that exciting opportunity to think about getting a foot in the partnership with these developers that have done this in many cases for tens or decades and have built billion-dollar portfolios, and now you can be part of those deals.
Yeah, the only thing I would add to that is that, it does behave differently, right? And, commercial real estate behaves differently, not only because of, that longer time period, But the way it responds to different market dynamics, whether it's the global public equity market or inflation, it behaves differently, and that's typically something you want in your portfolio. You want things that are going to zig when everything else zags, and that's a big part of the story of commercial real estate as an asset class. It's why institutions hold 10-20% of it. It is different. It behaves differently, and investors that are thinking about their overall portfolio, they build that in because of that specifically.
Brent, Chris, CrowdStreet, crowdstreet.com, link on the bottom of the screen, a link also in the description of this video. Guys, it's always a pleasure to chat with you about real estate, but also just about life in general. So have a good rest of your day, and good luck. And we're watching you closely because real estate is top of mind right now. So thanks for coming on today. We appreciate it.
Yeah, thanks, talking.
All right, let's bring it to our final guest of the day. And again, I just want to hammer home the point. Our next show, Benzinga Live, right? It's fun. It's zany. It's fun. But I take this stuff seriously. I take investing very seriously for myself and usually usually on this channel, not always, but usually I'm very serious on this channel, right? Because it's important, right? It is the number one way for the average person to build wealth without winning the lottery, inheriting money, or starting your own business, right? Those are kind of the 4 ways, right, to build wealth. And so this is part of that. These are the questions that the institutional investors, the people with the real money, this is what they think about. This is what they think about. I'm trying to bring it to this channel because I think it's important for everyone to think about it as well, right? Just because you don't have $1 million doesn't mean you shouldn't be thinking about these things. I think they're very, very important. And that's why we're going to be doing more of these, frankly, because I think it's so important. Seriously, we can all have our fun. On our next show, we're going to talk about some YOLO options trade. That's fun, right? But can we have some vegetables, please, also with our dessert? I think that's important. I really do. Okay, our last guest today is David Scherer. He's the CEO of Origin Investments, and I see him lurking backstage. I'm going to bring David. I'm going to bring you on right now. Is that cool? Give me the thumbs up. Okay, can you just turn for me though? All right, here we go. I think I got it. David, welcome to the show.
Well, that is weird. My camera's behaving weird. Let me see what's going on.
Well, just turn.
Maybe it's. Oh, I get it. It's this computer. Got it. Usually that's your software. Got it. Nice to see you. How are you?
Good. How are you?
I'm doing excellent. I appreciate the invite.
All right. Tell us about Origin and what you do for investors.
Yeah, of course. We invest in, simply put, 40 of us at Origin. We are across the country. We invest in apartments. We call them multifamily, but apartment buildings, usually 100 to 500 units per building. We're fairly large. We have just over $1.5 billion of assets under management right now, and about 2,000 unique investment partners. A lot of them are individuals. Some of them are investment advisors, family offices. I was listening to your last guest, and I think highly of that platform. The fundamental difference is there you're investing deal by deal, and here you're investing in one manager via a fund. So you'll be getting not one investment, but you'll get 10 to 12 to 15 investments per fund, which provides diversification. Both in vintage, but also geographic diversification. And importantly, we can talk about this a little bit, Spencer, but my belief is the most important thing you can do with alternative investments, and commercial real estate is an alternative investment. It's not liquid like cryptos or the stock market. It's really important to get the manager selection right. And if you do, you'll wind up outperforming, and if you don't, it might not be the investment that you hope.
So let's talk about that, right? So far today, we've spoken to a couple platforms that enable you to do some passive investing, with one platform that enables you to do a little bit sort of a hybrid-ish of the two, just regards to ETFs and stocks. What are the advantages of finding someone to actively manage this slice of your portfolio for you?
Yeah, that's the first question you have to make as an investor is, do I want to be active or passive in my alternatives? And so if you're going to be a deal by deal investor, the question I would ask is, are you trained in finance so that you understand IRRs and discounted cash flows, and you can get into the model and understand that side? And then do you have domain knowledge so that you can question the inputs? There's 4 or 5 inputs into every model that are really important. But you need the domain knowledge to sort of understand if it's reasonable or if it's a stretch. It's important. So if you have that type of training, you're able, or you can hire a consultant to do it. The professional investors, pensions, endowments, large family offices, they have teams of people who do this. They break down models, question assumptions. I would tell you that if you want to outperform on the deal by deal basis, you need to also be trained or have those sort of resources. If you go into the space where managers are managing for you, now you're vetting the manager. And Origin has written extensively on how to vet managers. If you go to our website, we have an education section, and there's literally hundreds of articles and videos about real estate investing. But there's also a lot of articles about how to vet a manager. There are things you should look for. And probably, Spencer, one of the first I would look for is this notion of alignment. Is your manager aligned with you as an investor? And I can sort of go into more detail if you want on that.
Yeah, I mean, what does that mean? And can you talk about, I guess, it's not necessarily a bad thing, right? If to acknowledge that, okay, this doesn't fit with me. That's not a knock on you, or that's not a knock on the manager. That's just a knock on the way you fit together, right?
Yeah, I mean, the notion of alignment, just to address that, is does the manager and the management team invest significantly in the deals and the funds so that they're aligned with the partners, the investment partners that are coming into the fund or the deal? And so it really is an easy way to sort of check the box or not check the box. Obviously, if a manager has very, very little money in their fund or their deal, they're not very aligned with the outcome in the way that the investor is. And if they do, they are. And so, at Origin, I would say we're probably one of the most aligned firms of all. Our investment funds, my partner and I have invested personally significantly. We're over 65 million of our own money at this point in our funds. And that's because we believe in our funds, and we want to be in our funds because we want to protect and grow our money in those funds alongside the investors. It's something an investor should look for. And then maybe the next thing they should look for are not just the returns, but the standard deviation of returns. And we can talk about that a little bit if you want.
I would like to explain that. For me, if you don't know, maybe just start with the very basic concept of standard deviation.
Yeah, so standard deviation is in finance the way that we measure the risk of a particular investment or investment strategy. So if you get to a return, but it's a very bumpy move, you're moving up and down a lot, that's a high standard deviation. You can also do it with a portfolio. So if you have 15 investments in a portfolio, and 3 of them triple your money and 12 of them lose your money, you might get a return that's actually okay. You might average a 10 or 12% return across the portfolio, but that's a very, very high standard deviation. It's telling you that there's going to be massive dispersions in the expected returns. What you want to see as an investor, especially in alternatives, is a very smooth and positive. Obviously, you want to make money, but you want to see a bunching of returns around an outcome. So if a manager says to you, I think that we can make 13 to 16% returns, you want to see an awful lot of activity around that and not zeros and 50s. The other thing that you can do as an investor is look at the biggest input into volatility or high standard deviations, and that's leverage. So the more leverage a manager uses, the more the standard deviation is going to be in both directions, because leverage is a magnifier. It's nothing more than that. If the deal is going to do really well, it's going to do even better because you used more leverage. If the deal is going to do not well, it's going to do really badly because you lose more leverage. So an easy question to ask any manager in any strategy, not just real estate: what's your leverage level? There's an answer to that question. And generally, if they're above 2 to 1 debt to equity, you should think very strongly about investing, period. It just gets to a point where I don't care how safe a strategy is, at high leverage, it's no longer safe.
Why do you focus on apartment and multifamily real estate?
Yeah, we made that decision really about a decade ago now. I believe, first of all, to outperform, you have to specialize. So not only did we make the decision about apartments, but we also made a decision about only investing in the Southeast Texas and the Southwest. And so we created our offices. Our people live and work in their cities, and we have infrastructure, to support that. But apartments is the first decision, and the reason was, historically, apartments are the lowest standard deviation. Back to that conversation, real estate asset class. They're also historically the highest total return. So it was a very easy decision, actually, Spencer, because you're looking at the highest return and lowest standard deviation asset class. The reason it's so low standard deviation, in my opinion, is it's an essential consumption. And so if you think about if there's a recession, and invariably there will be, there always is a next downturn. We don't know when it'll happen. But I can tell you what will happen, because this is what always happens in a recession. People cut down on their discretionary spending. So they go out to eat less, they travel less, but they pay their rent because that's an essential consumption. And we've seen that again and again and again. COVID is another example. When COVID happened, people certainly didn't travel, they didn't go out much. And people were worried that they wouldn't pay their rent because for the first time ever during COVID, you actually had the government saying, look, we're not going to give owners, I'm an owner, the ability to evict if people don't pay their rent. And so that was very scary for owners, because if people don't pay their rent, you have no way of finding someone who will pay rent to occupy that unit. And what wound up happening is, we went from essentially 100% of people pay rent all the way down to 96% in our portfolio. We have just over 10,000 units nationally. So
that still seems high. That still seems high to me.
In terms of 95% of people paid their rent and 5% didn't.
Yeah.
Yeah, I mean, statistically, when you go from essentially almost nothing to 5%, that's a big move.
Okay.
But in terms of the ability to service debt, the ability to provide cash flow dividends, it's actually not very high. And if you do it on a comparative basis, like, for example, office saw rent collections go much, much lower than that. And they didn't even have the government mandate, but people just simply stopped paying rent. So it's normalized now, Spencer, but the reality is, I view that as sort of the ultimate stress test. People were given the ability not to pay, and there would be no ramifications whatsoever, and 95% of people still paid. So I actually view that as very positive.
In your properties, that's the case. That's not the case everywhere, obviously. Why do you think that is?
Well, nationally, it was about 95%.
Right?
Yeah, you're right that our properties were a bit higher. We were at 96%. But no, nationally, that's what I mean. People really do view it as an essential thing that they're going to do and pay, and they're used to doing that. You saw a lot of behaviors change during COVID. I actually think it's probably, in my opinion, the first mass change of behavior event in my lifetime. So if you think about people, we're pretty habitual. We tend to do the same things in the same places. And then there's moments in our life for example, when we go to college or get married or have children, where behaviors can change. COVID is sort of the first mass exogenous shock I've ever seen, where it's not just someone who's graduating college or someone who's expecting a family. It's all of us having a change event at the same time, which is it's pretty extraordinary.
I just had a question. Oh yeah, my question was about, so one of the common, it's not a knock against it, but it is sort of a check in the downside box in terms of real estate is liquidity or lack thereof. It's not the most liquid asset class. Can you speak to that a little bit, and specifically liquidity in your investments on your platform?
Yeah, you're first of all, you're absolutely right. Private investments aren't as liquid as the stock market, and so our investments vary from being 4 to 5 year investments all the way to 10-year investments, and it really varies by strategy. Like for example, our typical development fund, and here we're targeting anywhere from 16 to 20% gross returns over that hold. But we also have qualified opportunity zone funds, and by law, to get the tax benefits, you have to develop and then hold for 10 years. So that's even a longer dated investment. That's why, Spencer, it's so important. First of all, I agree with our prior guest that there's a real need for alternative investments in portfolios. And if you look at the best investors, I'll hold one up. Unfortunately, he passed away recently. It was a big loss, but David Svensson, who managed the Yale Endowment for the last really 25 or 30 years, and redefined what investment looks like, because he did so well for so long that he actually changed the way endowments and pensions and family offices and large investors invest. And the Cliff Notes, he's written a lot of books on how he invested, but the Cliff Notes are two things. One, with stocks and bonds, just use the cheapest way to get beta because they're efficient markets. It really boils down to fees. With alternative investments, and you need to have a lot in your portfolio, he was sort of 20 to 30%. He was one of the first to do it when he was doing it in the 80s and early 90s. And then there's been sort of mass adoption. But in alternatives, you need to pay for the best managers, and you need to have a real process to select the best managers. And if you read his books, and I met and spoke to him a couple times, he won't tell you how to select. And it's frustrating because that was his secret sauce. His secret sauce was picking the right managers. There is a way to teach yourself how to select. And back to your question about liquidity, alternatives in general aren't as liquid. That's not bad, it's just different. There's a place in your portfolio for it. You don't want all of your investments behaving the same way at the same time, and
Sure.
provides that protection. But because they're illiquid, you have to get manager selection right. And that means not just competency, but team and also ethics.
Quick, real fast, David, before we hop off here, how do I get on the origin of the platform? What qualifications are there? Fees, that sort of thing.
Yeah, unfortunately, we only work with accredited investors. So you have to be an accredited investor. So that's someone that's making $200,000 a year or more, or as a family, $300,000 or $1 million in net worth. So all of our products require that right now. We do have, I would say, our minimum investment is $50,000 per fund, and you're obviously getting diversification across 10 to 15 assets, typically in a fund. We have funds that sort of a 9 to 11% annual return, and those are very low risk funds. And then we go all the way up to development funds or qualified opportunity zone funds. So it's really up to the investor to understand, and we have plenty of people who can help educate them here what their goals are and what risk return they're willing to take. We are a top 2% manager over the last 14 years. We're really proud of that. And so, we're proud of the returns that we've had, and I think our clients appreciate that. Our website is the easiest way to get a hold of us, www.origininvestments.com.
Yeah, it's the link is on the screen there, everyone. It's also in the description. Yeah, I love it as much as people ask me. I get asked all the time, like, tell like, wait, give me a stock, right, that you like, and I want to, and sometimes I do, and I want to, but like, that is not a that is not a strategy, right? You should not buy something just because I said so, right? It's like or anyone for that matter. You have to do, Shazing in the chat, right? You got to do your own DD, whether it's, picking your own investments or whether it's picking someone to pick your own investments, right? You, you sort of just have to learn how to do it, and doing something because someone tells you to is just not the reason to do it. So, David Scherer is the co-founder and CEO of Origin Investments, company that provides access to residential real estate, multifamily apartments, that type of real estate. And David, definitely will have to have you back on because again, I could talk about this all day. It does not get talked about enough, and so I hope we can have you back again and talk more about just investing in real estate, how Origin fits, what investors are doing on your platform, what trends you're seeing, because the space to me is endlessly interesting. So do you have any final thoughts for us?
No, I really appreciate your time, and I can't stress enough that you work so hard to accumulate and get ahead.
Yep.
And just be really contemplative about how you use alternatives and understand they are liquid. And it's not just the managers selecting, but they also have to execute, right? We have to select, then develop, then add value, then run, then operate, then manage risk. There's a lot going on. Obviously, report. All of these things really matter, and you need to pick the manager carefully.
Sure. David Scherer, co-founder and CEO of Origin Investments. David, thanks a lot. Have a good one.
Thank you.
All right, guys, we got to wrap it up. I'm running a few minutes behind. I know that. I'm sorry. Our next show, Benzinga Live, should be live right now. The new SPAC segment, okay? The new SPAC segment. Chris, Mitch are live with Aaron Bree right now. I'm going to end the stream, redirect to those guys. Give me a like. Give me some feedback. You know what I mean? Give me some feedback. Email me if you want. You can do that, shows@benzinga.com. Let me know what you think. You like this. You like that. You didn't like this other thing. You want to see X type of company or Y type of company. Let me know what you think. We want to do more of these. We're going to be doing one of these probably every single week next year, about alternatives, about whatever. So drop us some feedback. Hit the like button, please. And I'm going to end the stream now with a commercial for our swag store. It'll redirect automatically to Benzinga Live, which should be starting imminently, if not already.